Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and just wanted to give you your weekly market update. And right now, we want to get started with what's going on with mortgage rates. So I'm just going to read something to you here. Basically, we'll jump right in to some of the factors going on. But please make sure you like this, subscribe, follow, share with your friends, and really would help us out a lot, making sure that we're getting out there to people and getting all this great information out there. And again, I'm only giving you the numbers and what I can go off of my best educated ideas here of what we're getting from the market stats themselves, straight from the MLS, the Crawford market report, and some of the big names out there that would tell us what's kind of going on with the market nationally, but more importantly, what's going on in the local Phoenix market. So nationally, we're looking at mortgage rates, first of all. So the average 30-year mortgage rate fell to 5.7% this week. So this past week. So that's down from 5.8 a week ago. All right. And again, these are just the average rates. Again, they fluctuate by the hour, by the day, by the week, all that. It also does matter who you're using for your lending. And we have some great people out there with Modern Home Lending. My wife, Cynthia, is a loan officer, full disclosure. So is our son with Modern Home Lending. But they are a mortgage broker and they shop the best rates. Make sure you get those best rates out there. And then from there, they can figure out, the best pricing and all that too, and get you the best terms possible. And what we're seeing is with a lot of these companies out there, they're kind of maybe, they're charging more for fees. They're even higher interest rates a lot of times. I think that in anticipation of not only, us being in a higher interest rate market, but those other rate hikes that the Fed keeps saying are still coming down the pike, even later this year and into next year, probably. So I'll have to see how it goes. Some of the greatest minds out there are saying, just like in any economy, we'll probably see when we have inflation, we'll see the interest rates go up. And then eventually, once we're in a, bad economy or recession, which, basically that's where we're at now. Once we're in that long enough, the interest rates will then come down again to offset that. So it's kind of like, in a lot of ways, it feels for some of us that the brakes have been put on in some areas and locales around the country, in the Phoenix area. It may seem that way for a couple of reasons that we'll talk about here. So a year ago, this time, that 30-year rate was averaging at 2.98. Again, that was just the average this time last year compared to the numbers we just went through. And again, this is the rapid rising. In this article I'm reading from here, basically gives us the rapid rising of mortgage rates has finally paused, largely due to countervailing forces of high inflation and the increasing possibility of an economic recession, says Sam Cater with Freddie Mac's chief economist. Rates trend to mirror 10-year treasury yields and have fallen as investors seek safer, more stable assets in the face of higher inflation and slower economic growth. So, one of the things that is interesting is usually if the stock market's in trouble, people run to the bond market. If bond market's in trouble, people run to stocks. Well, recently they've kind of both been bad. With the housing market, we've seen that, it's definitely had a slowing effect with these higher interest rates. So people are still, if they're looking long term, are still looking to keep their real estate assets, obviously, because not having any assets is not the way to go. You want to have an inflation hedge. And even in the slower, more moderate markets here in the Phoenix area, we would still be looking at 5 to 7% gains historically, and nationally be looking at about 3 to 4%, right around there. So that's per year in equity gains. But some people are also looking at things like gold and silver and all those sorts of things. But one of the things that this article goes on to say is from Redfin. It says, as the housing market cools down from its red hot pandemic pace, Redfin economists foresee home prices flattening or rising modestly next spring if it would take more than just higher mortgage rates to send prices lower, says the brokerage's chief economist. And why is that? Well, people always have to have a place to go to, a place to live, and those sorts of things. And a lot of it's going to depend on your area. Do you have a growing economy? Do you have more jobs coming to an area? Do you have more businesses coming to an area to create those jobs? Do those businesses create other jobs, and so on? And I'm going to be talking more about that here in a minute too, about the Phoenix area specifically. So, it's good to stay on top of those things to kind of understand maybe where your market's going to. Are you in a very depressed area, or are you in an area that's kind of thriving in a lot of ways, especially with, the usual things, but in areas like Phoenix, we're big with hospitality or people coming here seasonally. And now we've seen over the past several years or decade with a lot of tech jobs. So along with hospitality, transportation, even aerospace. So, we're into next spring, nationally, this Redfin advisor saying in the 2023, they're saying, we may see 4%, a flattening to 4% or so in the springtime. So slower economy, slower housing market nationally. And I could see that nationally, but in certain areas, of course, we're going to have, less of an economic impact, just because if people are moving into these places for jobs, they have to have a place to live. Now, not all of them are going to buy, but a great percentage of them are going to buy, and they are buying. And they may even be coming from places that cost a lot more to live in too, like California and so on. So now, I mentioned this last week. I'm going to get into this a little bit more this week. It's called the contract ratio from the Crawford report. And this is our local gurus of real estate that give us all the kind of deep inside the numbers. And this contract ratio brings us even a little bit more in touch with what's going on with the market, even more so than the CMI, which we talk about every week. I'll talk about here in a minute. But this contract ratio is something that, well, I'll just kind of explain to you what it is here in a little bit more detail. But it says the contract ratio is a simple and immediate measure with no averaging or smoothing effect. It is therefore and responsive to the violent changes like we're seeing right now, where we're seeing like, we're insanity mode on seller side. And now we kind of see like a little bit of a break on that for a few reasons that we'll get into. Violent changes in the market. In contrast, the Crawford market index is based on averages over the prior 30 days and is smooth to avoid reacting to insignificant variations from day to day. Normally gives more of a reliable picture of the market than the contract ratio. However, in times of dramatic change, this contract ratio can, be a little bit slower, move a little bit slower because of the, or CMI can move a little bit slower than the averaging and smoothing. I would take signals from the contract ratio to be more up to date by an average of 2 weeks compared to the CMI. At the moment, the CMI is clearly telling us that the market is cooling rapidly, but it would probably understand by a week or two just how far it has already cooled as of July 1st. So the contract ratio is telling us that we are already in a balanced market. Got that? We're already in a balanced market according to contract ratio. If it drops below 30, on the index, then it will indicate a cold market with a significant surplus of sellers over buyers. We have not experienced a market like this since 2009. Okay, so let's take a look at that. Right now, so the contract ratio for between 30 and 60 would put us into a balanced market. Right now, we're at a 59.8. So we are technically in a balanced market. Just 4 months ago, Just 4 months ago, we were at 262.6 on the contract ratio. So this 58.9 that we're at right now this week is the lowest since March of 2019. Okay, so we are already in a balanced market according to this, and that rates more of a volatile market. Okay, now looking at the CMI, if we just first just take a look at the cities as a whole, or one by one, I should say, if we look at those, we, according to what we're seeing with the contract ratio, the CMI, and everything put together, we are being told by the Crawford Market Index people that we're probably going to be into a buyer's market by the beginning of September. That, what does that mean? That means you're going to have an increase decreased in list prices, not overall actual appraised average appraised value. Okay, let me explain that again for those who seem to think we're going to be like in this bubble that's crashing. Okay, when we were in the insanity of we've hardly got any houses and all these people moving here and low interest rates on top of it, the super high demand, we had people basically buying whatever was available because they had to move or wanted to really move or needed to get in to get their job, right? Or get out of maybe mandated areas, pandemic mandated areas, or whatever the case was over the last couple of years. So, you know, what we were seeing was literally, it was like on every listing, even with cash offers, investor offers, it was absolute insanity where we would look at, you know, we have a kind of a range in the comps, the comparable sales, there's a range. Okay. There's a low, an average, or you know, middle, average, and then high end of the comp range. So it was like people were either at the high end of the comp range always, or they were at the high end of the comp range, plus they would add on 20, even $50,000 for a listing price, and they would get it with multiple offers. I mean, we were up to, you know, we were at a point where we were getting like 20, 30, 50 offers on a property. So you've got to kind of get it, that understanding of the comp range, and then what is actually the average appraised value of what's actually going on. And, you know, looking at a city block, looking within about 200 square foot of, you know, the subject property that you're looking at. Is it a 1 or 2 story? Does it have a basement or not? You know, does it have a 2 or 3 car garage or garage at all? Has it been updated or not? Is it in the trend of what people want today? Okay, versus maybe something that's very outdated. Does it have a pool or not, and how much you can get on an appraisal for that? So all that, you know, when you're in a real market, a balanced market, you kind of take all that into consideration. You don't just have the insanity of, hey, we're just gonna, we need to buy something, so we're gonna buy it now. Okay. And we also we're kind of behind on our new builds. That isn't the case anymore, and I'll talk more about that in a minute. So with all that said, keep that in mind that we're actually going to be going with the reality market, a balanced market, a reality market of the actual average appraised value, not what the guy got down the block, you know, 4 months ago, 5 months ago. We just can't go by that anymore because the supply has doubled, even almost tripled, which I'll talk about more here in a sec. And then, you know, the interest rates have basically gone up almost double from where they were a year ago. So you've got to, as much as you want to get more out of your house, you got to kind of get that understanding of what's going on and where people are at. So, you know, either you just kind of internalize that, go with that, or wait to get more on your property later. So Buckeye right now is the lowest on the CMI. They've got the highest in inventory. They're actually moving pretty well as far as getting properties under contract, but they've got the most inventory that is out there. So they saw that in Buckeye right now, they're the lowest on the CMI index. They're at a 110, which is actually right there, because anything over 110 is a seller's market. Anything below a 90 is a buyer's market, and anything in between is a balanced market on the Crawford Market Index, the CMI. Again, this is different than the ratio chart that we were just talking about. So Buckeyes at 110.8. The highest right now is Fountain Hills at 265. Okay, that's the highest. So they are the most sellers market, highest in the sellers market category in the entire valley. Then from there goes down Paradise Valley at 234, Scottsdale at 205, Avondale at 189. Okay, Avondale was at 300 a month ago. Now it's at 189. Glendale 185 currently, just over 185. Was 317 a month ago. That's a 42% drop. Avondale had a 37% drop in a month. Mesa 184 on the Crawford Market Index. Again, over 110 is the seller's market, but just a month ago Mesa was at 294. Okay, so again, Goodyear's at 182. A month ago it was 289. Both Mesa and Goodyear are down 37%. Surprise is down 38% at 167. It was 268. So I think you kind of get the idea. Phoenix itself, Phoenix proper, is at 167.3, down 40% from 280 just a month ago. Chandler is at 156, down 40% from 262 just a month ago. Gilbert 156, currently down 40% from 261 just a month ago. Peoria 154 right now, down 40% from 257. And then you've got Maricopa at 121 and Queen Creek at 119, both down. Maricopa down 34%, Queen Creek down 37% from a month ago. And again, Buckeyes down 31% from 159 to 110 currently. So they are right there at 110.8. Just barely in that seller market here. Again, over 110, seller's market. Below 90, buyer's market. So we'll be in a buyer's market overall. If we keep going in this direction, to buyer's market overall by September, and new listings actually in the last 7 days, last week to this week, actually from 2,500 to 1,600 though, we've gone down. So, we've got a little bit of a FOMO thing going on here with this surge in inventory. We have to look at, like, who are these people? I'm going to tell you exactly who they are in just a minute. Okay. Are they investors? I'm going to give you some of the percentages on this, and then it'll make more sense. But the overall CMI is at 177.6. The demand is at 88.2, right? 88.2. So, that's right in the lower range of where we want to be. And then supply 49.7. So contracts accepted 2 weeks ago, 1558, down from 1898 the previous week. The same week in 2021 was 2274. Least productive week in the last 2 years was this past week, leading into and through that holiday weekend last week, July 4th. So the least productive week in 2 years, lower than April of 2020, which is a good indicator because that was what? Pandemic, right? That's when we went into all the crazy stuff with the lockdowns and everything, and we had the pandemic announced. As formally anyway. Supply, we've got more homes newly listed for sale than any time since 2011. Since 2011, and there's 133% more than 2021, and we got 200 new listings coming on the market per day. Prior to the drop in numbers that I gave you from last one, from 2,500 to 1,600, we had that 133% more prior to that. Then we just saw this current drop. There were 200 per day, and now we went from 2,500 from that, went from 2,500 down to 1,600. So what does all this mean? What is it leading us to? So let's tell you. We saw in the last from 12 weeks ago, we saw active listings increase by 150% in 12 weeks. 12 weeks. Okay. And way above where we were last year. And that obviously, when you have higher supply, again, I went over this, tried to stress it the last couple of weeks, but when you have this influx of, right straight through last week, we had up to 11,845 new active listings. And I checked it today. That was as of last week. I checked it today. We were over 15,000 today. Hang on a second. Let me pull it back up here. Okay, so it's just single family, only active, not under contract, not pending, none of that, no coming soons, just active properties, single family detached, 12,961 right at this moment. And altogether on the MLS, it's 15,568 currently. Okay. So we were down at levels around, just over 4,000 back beyond that 12-week mark. And prior to that, we were low levels. And so we've seen this huge increase in listings. So when you have an increase in supply, and then you have higher interest rates, and it decreases the demand because of the interest rates and the prices, what's going to naturally happen? You can market the death out of something. But when you're trying to get what people, you're taking those comps from, 3-4 months ago, today, dropping them in there. Maybe you don't have a pool. Maybe you don't quite as up to date. And you're trying to get that insanity market again. It's not there anymore. Not right now. It's not. But let's look at who's selling. So the active supply percentage by intended use from the Crawford report. All right. So without getting too far into the weeds on this, we've got 55% of active listings are vacant. What does that mean? Vacant. Majority being new homes, second homes. Okay. So we have seasonal visitors. Okay. Or their rentals, whether they be long-term rentals or Airbnbs. 18% were purchased in the first half of 2022. This is this new influx of listings of that 11,800. This is how it breaks down as of last week. 18% were purchased in the first half of 2022. Okay. So they were purchased in the first half of 2022, and 5% were purchased in the second half of 2021. So what does that tell us? We had a lot of flippers, we had a lot of investors, we had a lot of second home people, we had a lot of rentals, people maybe playing around with the flipping game, playing around with the rental market, even going back into the data. If you look at, the pandemic, when the interest rates were low, people trying to get into the Airbnb and rental thing, understandably so, with the low interest rates. But a lot of these are new home builds too, so they're vacant, right? So new construction supply in the last 10 weeks is up 169% in the last 10 weeks, 169%. Okay. That makes a big difference in what we're looking at. A lot of these builders now, that the lumber costs went down. They're still having trouble getting trades, and still having trouble getting some supplies and stuff. But a lot of builders we talk to, they're just basically building. As soon as they get a piece of land, they're just building. A lot of them now are just doing what we call spec homes, where these properties they've already picked everything out. They're just building the homes just to get the inventory out there, because we were so low on inventory. And technically, so we're still low on inventory. We still want to be more between 20 to 30,000 to really have a totally level playing field, or getting into maybe where we're getting the normal appreciations of, in the Phoenix market of 5 to 7%. But that is what's making the difference and who is selling these properties. The active supply is just off the chart. When we look at new construction, Queen Creek is number one, Buckeye number two, then Scottsdale, then Surprise, then Phoenix, then Maricopa City, Mesa, Casa Grande, Goodyear, Arizona City, Peoria, Litchfield Park, Gilbert, Laveen, Avondale, Florence, Whitman, Tulsa, Glendale, Tonopah, Paradise Valley, Cave Creek, Eloy, Chandler, and Wickenburg, and then so on from there. So new construction supply as of June 18th of 2020, that's basically where that's at. Moving right along, if we look at accepted contracts versus back on market, we saw a lot of the Wall Street institutional buyers canceling escrows in the last week, mostly between, they're mostly within the $400,000 to $500,000 range. So we saw that fall out. So we see those properties back on market. That's added to the supply. So some of this, in other words, some of this could be transitory. I hate to use that word because we certainly don't have transitory inflation. We've got inflation that's been going on for quite a while, and the last couple of years, since about March or so of 2021. And we're continuing to see that, but that also resonated in the housing market. But now with this extra supply and high interest rates and a decrease in the demand, or the over surplus for the demand that we've got with those interest rates, we're seeing this change and this shift in the market. But when I explained who those people were, if it's a second home, if it's an investor selling off, because and this is typical when rates go up considerably, and people feel like, well, maybe this is kind of topped out for now, or we're not going to see the 32% appreciation that we saw last year or the year before. We're going to get out of this and kind of get our money and call it good, put it into other things. So that's pretty typical. But so once those properties have actually sold off, and we've got the FOMO, fear of missing out, sellers out of the way, we may see that supply might, maybe, not promising anything, not saying I got a crystal ball, but maybe some of that will be gone, because a lot of those people are not buying other properties, they're just selling off, right? So we'll see. The appreciation in the median sales price. So we see definitely a leveling off there, which we've been talking about now for a couple of weeks. But June to date, every month, if you go back, into 2021, we've seen an increase of anywhere in the low ones every month, and the low ones even up into some months where it was up to 2.9% for the month. So those are huge gains. And now we've seen a leveling off. Median price is right around 480, which I mentioned last week. But the 10 counties with the biggest growth, if we look at July 1st, 2020 to July 1st of 2021, was number one county was Maricopa County, right in the Phoenix area, greater Phoenix area, with a huge amount of growth of 58,246 people. And there's a reason for that, right? And the reason for that is, well, we have this thing called what? Jobs, right? So what's bringing the jobs here? We've got huge hospitality market, aerospace, we've got all kinds of stuff happening here, but we've got this Taiwanese semiconductor manufacturing company moving here up near the 303, up in the northern region of the Phoenix area, near Peoria and Anthem, and up in that direction off the 303, up near Surprise and all that. And that's the TSMC, Taiwan Semiconductor Manufacturing Company. So that's bringing in 1,600 new jobs. That obviously brings in other jobs. That's also bringing in other, commercial building out that way. But it brings in, other retail, huge complexes that they're building out that way. But it also, kind of brings in all this new, high paying jobs. Guess what? Those people need a place to go live, right? So what does that mean? That means that brings stability, that brings consistency to our market for sure in a much stronger way. So that's a great thing. So you've got to keep these things in mind when we're looking at, are we going to have a crash or whatever? I think a lot of it is going to be driven definitely by the things we talked about for sure. There's no doubt that, things that are happening with the interest rates are definitely going to be a factor, but our local supply is also going to be a big factor, and our jobs and our economy is definitely going to be a driving force in what's going on. So a lot of the builders are building in and around that area for new homes and for all these tech jobs coming in. We've got to keep that in mind, along with already strong economy that we've had. But that was decided back in 2020. We're going to see kind of a full with that Taiwanese plant and the semiconductor plant, because we've got China breathing down the neck of Taiwan, right? Without getting into the weeds of that. Hopefully by about 2024, they're going to see where that semiconductor is all brought in, but it could be as long as 10 years before that's really in full production. So let's hope that we don't lose Taiwan. But that's kind of the goal there, is by 2024 to kind of have that up and running strong. But that is really about it right now, guys. I think I could go further, but I think that's long enough. And one thing I would again keep in mind is this is also a great opportunity for buyers. Real quick, again, don't focus on the one number and the interest rate. And again, we can get you better interest rates than you're seeing out there, but you want to make sure you're looking, at the whole picture when you're a buyer, and that is considering, locking in a price versus rent that can go up. Look, last year went up 18-19%. As a whole in the Phoenix area. The appreciation factor is still going to be there, and it's just going to be a little bit more moderate and more normal for the at least for the immediate future. And then tax benefits and quality of life, right, with owning your own home. And we know about the Phoenix market. Prices are again are going to go up and appreciate even steadily. Rents are expected to go up still. Certainly for first-time home buyers, the rental market's going to be a huge thing, especially with a lot of the first-time home buyers that can't afford to buy right now. Arizona, like I said, is still creating jobs, and a lot of buyers can get into a lot of good situations right now. We're going to be seeing probably within the next, we've seen a little bit of it. We're going to be seeing more in the next month or two, where sellers are going to be paying seller concessions again, probably by September, if things, unless something drastic were to take place. So that's kind of where we're heading. We look at those factors, again, an increase and decrease in the listing prices, the increase in days on market and an increase in concessions. That means we're in a leveling off or possibly even a small downturn in the overall list prices again, but not in the appraised value. Okay, not in the appraised value. Huge difference, like I mentioned in the very beginning. And again, number three, there's always ways to make money on your own property that you own. And that is in appreciation, tax benefits, principal buy down, just a principal buy down, a loan, and then the positive cash flow that you can get out of it if you want to rent it out or Airbnb it down the road. So Guys, I think that'll do it for now. If you guys have any questions at all, want to get into more detail with these numbers, want to get into more details on your property, if you're thinking about buying or selling, want to find out more about what may look like for a lot of people are still doing cash out refis right now because they got tons of equity. That's another thing. People just have tons of equity right now. We're seeing that people are taking advantage of that, pull out money or sell, and that's a good thing. But it's a great opportunity for buyers right now with the shift in the market. Take advantage of that too. So if you guys have any questions, make sure you check us out online at McCulloughHomes.com, McCulloughGroup.com. Email us at home@McCulloughGroup.com, or you can always call or text us at 480-788-8569. And make sure you like, follow, share, and subscribe to all of our social media. Talk to you soon. Thanks.